Most EB-5 projects are built on debt levels that no institutional lender would approve. The investment terms being offered to EB-5 investors, the returns, the recourse, and the position in the capital structure would be rejected outright by sophisticated institutional lenders. That is not an accident. There are developers and promoters who use EB-5 precisely to leverage the information gap between American institutional capital and foreign immigrant investors. That's what this series is about. If you're currently evaluating an EB-5 project, or if you've already been presented with an offering and something about it just didn't quite sit right with you, there are 3 things you need to understand before you commit capital. 1, how much debt is your project actually carrying? 2, the legal structure that determines what rights you have if something goes wrong. And 3, a lending instrument called a mezzanine loan, which sits at the center of most EB-5 deals and which most investors have never had properly explained to them. We're going to walk through all 3 of these things in this series. This video is the overview. Parts 2, 3, and 4 go deeper on each one. Links are in the description. I'm Josh Godden. I'm Managing Director at InvestMigrate, and we've been helping clients from all over the world take a hard look at debt in EB-5 projects for over 15 years. How much debt is your EB-5 project actually carrying? Let's say, for example, a hospitality developer has a project they'd like to build. They go to a bank, and the bank makes a commercial loan that is secured by a first mortgage on the actual property. That loan might cover 50 or 60% of the total project cost. If the developer is very creditworthy and the project has exceptional prospects as a business, maybe more, but probably not much more than 70%. Developers try to invest as little equity in projects as possible to minimize capital risk and maximize return on investment. So they'll usually look for another loan to reduce their equity investment to 20 or even 10% of the project's cost. America's capital markets have an entire industry of firms that specialize in filling this gap with options like private credit lending and mezzanine loans. These firms lend at higher interest rates with stricter terms because their collateral rights are behind the bank if anything goes wrong. Often, they are mezzanine lenders with no collateral rights at all. An institutional mezzanine lender will typically charge 12 to 16% interest and lend with strict performance metrics. If the business doesn't perform, the mezzanine lender could end up taking over the company entirely. That's the market price for the risk. EB-5 is popular because commercial real estate developers and other business operators want financing with the best terms and lowest interest possible. And EB-5 capital beats America's capital markets on both counts most of the time. By taking on the management and administrative overhead of EB-5 regulatory compliance and working with many small investors, developers can often get far better terms than American institutional capital markets will offer. This is the actual intent of the Regional Center program. Sadly, some participants in the industry package their projects to look more financially sound than they actually are. Then they offer EB-5 investors extremely low returns with outrageous terms based on this packaging. Some are hoping to extract value from their businesses earlier and more cheaply than American capital markets would normally allow. Some have businesses that American capital markets wouldn't finance under any conditions. The strongest indicator of which kind of project you're dealing with is how clearly the financial and legal structures associated with the investment are presented to you. In this series, we'll walk you through how projects borrow money, the different layers of debt, and the financial instruments that decide the terms of the debt, who has recourse, and how all of it affects your EB-5 investment. In most EB-5 projects, you are not investing directly into the business that creates the job. You are investing into a separate company, a special purpose vehicle, which in EB-5 terminology is called the New Commercial Enterprise, or NCE. The NCE is the entity you put your $800,000 into. It's the actual EB-5 project. The business that builds the hotel or operates the facility is a separate entity called the Job Creating Enterprise, or JCE. In most projects, the NCE and the JCE are separate companies. So the question becomes, what is the relationship between the NCE and the JCE? How is your money actually being deployed into the project? In many projects, the NCE is making a loan to the JCE. The nature of that loan matters enormously. Is it a standard collateralized loan with recourse against the actual assets of the project? Is it a mezzanine loan where your recourse is only against the ownership rights in the company and the bank has the sole lien on the real estate? Does the loan have recourse against the developers or some other guarantor's capital? What interest rate does the loan charge, and what are the default provisions? In some projects, the NCE isn't making a loan at all. Instead, it's buying preferred equity in the JCE. This is a different instrument with different rights. Your position as an investor depends on the legal terms of that equity arrangement, the governance provisions, and what protections are built into the operating agreement of the company you're taking preferred equity in. Each of these structures has a different answer to the question, what happens to my $800,000 if this project doesn't perform? We'll go through the specifics of each model in part 3 of this series. If there's one thing I want you to take away from this video though, it's that if you are looking at an EB-5 project and you cannot clearly understand the terms of the investment or how your money is being deployed, this is a huge red flag. Where is your money going and on what terms? Is the corporate structure transparent? Are the legal terms intelligible to you? If the answer to those questions is no, a project's financial outlook becomes a moot point. It can make a fortune and still not redeem your investment. I don't mean this hypothetically. This actually happened to several hundred investors in one of the largest EB-5 projects in history, entirely because most of them didn't read the documents. Developers take mezzanine loans because commercial lenders will only allow a certain percentage of the asset value of a real estate project to be leveraged as collateral for debt. If the developer needs capital beyond that limit, the additional debt can have a claim on assets of the project. That is mezzanine finance. Because they have no recourse against the project's assets, institutional mezzanine lenders charge 12 to 16% interest. They also demand strict performance covenants and terms that can end with the mezzanine lender taking over the company entirely. In EB-5, the majority of projects use mezzanine loan structures. The NCE collects investor capital and makes a mezzanine loan to the JCE. You occupied the same structural position as an institutional mezzanine lender, behind the bank with no lien. To emphasize, you are investing in something that has no claim on real estate or other major assets. That can be a reasonable trade-off if the terms are honestly presented and the deal is structured fairly. The developer gets cheaper mezzanine capital than American institutional markets would normally offer, and in exchange takes on the regulatory compliance and investor relations overhead that comes with EB-5. This can be done in good faith. However, there are also projects where the mezzanine structure is used to give EB-5 investor terms that no institutional lender would accept. They do this because they know many immigrant investors have no experience with commercial real estate finance and will assume they're investing in loans that are secured by real assets. This exploitative approach to EB-5 is far too common, and we will break that down completely in part 4 of this series. Those are the 3 areas we'll cover in this series: leverage and debt load, investment structures and recourse, and mezzanine finance. Each one has its own full video. Links are in the description. If you're currently evaluating whether EB-5 is right for you and all of the details seem overwhelming, contact us. As consultants, our approach is to arm our clients with enough information that they can look at any project and answer many of these questions for themselves. Book a call through the link now. Also, remember, the September 30th, 2026 application deadline to lock in the current $800,000 investment threshold is approaching fast. After that, your investment is no longer protected from future changes to EB-5 policy, including minimum investment. Once again, if you're going to invest in an EB-5 project, make sure you actually understand what you're investing in before you commit. Contact us.